It's my honor and pleasure to introduce Rishi Kohli. Rishi has over 22 years of experience in Indian financial markets, both on the buy side and the sell side of the public equity market space. He has a lot of firsts to his credit. In 2007, he launched and ran India's first quantitative hedge fund. And in 2011, he launched Asia's first systematic managed futures or CTA fund as part of Pro Alpha, a unit of US-based Monsoon Capital, which had marquee global investors as its clients. His fund in 2011 was voted as Asia's best first fund. Rishi, in 2022, he joined Incred Alternatives, where he spearheads alternative strategies and hedge fund strategies. Over to you, Rishi.
Hello, everybody. So today I'll talk about the quant strategies. I'll give initially a global perspective very quickly, and then focus on what all is possible in India. So when that is coming up, I'm sure many of you have seen the data or heard that passive strategies have hugely increased over the last 10 years globally as well. In India, of course, you're starting to see some initial signs of that. But of course, there are quant funds globally as well, quant hedge funds, which have been around for a long time as well. So that boom, both on the traditional long-only side as well as the hedge fund side, has been happening in the West, in US and Europe for the last 10 to 20 years. And both of that has just started happening in India over the last few years, I would say. I moved long back from the sell to the buy side in 2007-8 period. And at that time, my belief was that some of these things will start picking up in India, in the next few years. So I was a bit early at that time. That time it had not happened. But now, some of that has started happening. So I'll skip this. Vijay briefly mentioned about my background. You all can look at some of the things later. So what is quant to begin with, right? For some of you who have not seen the basics. So in simple terms, it refers to a rule-based investment process, that relies on applying various models to the underlying data. The good thing is that you can have a disciplined process. You can understand the various risk-return possibilities in various market conditions, and then sort of get a better sense of how that would play out in real time going forward. It can delve into many different segments. It can be fundamental, it can be technical, it can be statistical. So there can be many different techniques of doing quant. Obviously, there are certain assumptions you make about the model. They assume something that, past cycles, once you've studied them, would help you going forward in real time. Obviously, as we know, it's not always the case. It doesn't exactly repeat, but obviously it rhymes, as they say. So that is what one would expect. And then, of course, all these models have a shelf life. So it's not as if they will always keep working at all points in time. Which is why, as I'll talk about, you need to have a diversified approach in some sense. And then what I would like to highlight is, since we are a cricket-crazy nation, quant investing and cricket, there are some similarities, right? So models bring you the discipline because it's a rule-based approach. There's a systematic process. Similarly, in cricket, also you need a lot of discipline. Getting the right mix of players is important. There you need bowlers, batsmen, all-rounders. As I was mentioning earlier, in quant side, you need diversification of different strategies, maybe time duration, and many different types of models. And then you want to maximize returns and minimize risk, right? For any level of risk, you want to have the highest return possible. For any level of return, you want to have the lowest risk. So analyzing that from risk-reward perspective and not just returns is also very important. And then, of course, managing risk and enhancing the risk-adjusted performance, which is broadly devising a game plan in cricket terms, at least. Now, this is quickly the growth that I was mentioning earlier. So on the left, you see the growth in the US. The data is slightly dated, but similar sort of growth has continued to happen over the last few years as well in the US. So there's been a scorching growth in a market that is already well developed on the quant side. In India, as I said earlier, last few years only some growth has been seen, and we are scratching the surface right now from a global perspective. But at the same time, at least there's been some growth, and the last 2-3 years especially, there's been a big jump. So there's a lot to look forward to. There are a lot of well-known larger mutual funds also which have, have either some quant products or some, factor kind of index funds. So again, initial activity has been seen, and a lot more obviously needs to be done. This is the same global data, but broken down between different categories. I won't spend too much time on this. Yes, now coming to the main part of the talk, there are lots of quant strategies globally. So what I've seen is that in India, the moment, someone says quant, we'll all say, oh, you're doing algo trading, right? So somehow we have related quant to algo. Now that is very, very wrong because algos are basically execution mechanisms, right? So it is what would be termed as execution quant. So anyone focusing and specializing in pure building algorithms for the trading is basically an execution quant. Whereas I am a research quant, I'm not an execution quant. Within research side, quant is a very big field. The execution side is important most for HFT kind of strategies which are trading, milliseconds, multi-seconds, whatever. It is important for other strategies, but only when you are dealing with large size and you want to minimize your impact in the market, etc. But what I would talk about today is all the types of strategies, because that will give you a good sense of the breadth and the depth that is possible using these strategies. So there, of course, I break it down into long funds, arbitrage funds, and long short funds. Long funds, largely factor investing, smart beta, quantamental. These are again different terms I'm sure you've heard. I won't talk too much about that today since we have a very good session from a global well-known name later. But I'll focus on the other categories, which are arbitrage funds and long short funds. Within arbitrage, you can have statistical arbitrage, volatility arbitrage, and then what is popular in India, cash futures arbitrage. That, of course, is more an Indian phenomenon. It is not really prevalent globally much because globally you don't really have single stock futures in most of the markets. So it is more an Indian phenomenon, therefore. But statistical arbitrage and volatility arbitrage are very big areas globally. And then on the long short fund side, you have managed futures or CTA strategies as they used to be called long back. And then you have equity long short. And absolute return, again, is more an Indian phenomenon on the equity long short side, which also I'll talk of. So long quant strategies, again, I'll just rush through this since you have a session on this later. You can focus on many different factors in a nutshell: growth, quality, momentum, volatility. You can have single factor approaches, you can have multi-factor approaches, you can combine all of these. And then there are globally funds on each theme separately or on the multi-quant side also. In India, I think initially what has been well received by the fund side, at least by the managers themselves, is a quantamental kind of approach where people are using quantitative screeners for filtering down from whatever universe you have and then applying some traditional fundamental analysis or logic on top of that. I think that is pretty much being followed across all the large funds in the country. But specific factor funds, there are a few across fund houses, but not as many as the scope can be. And you don't really have multi-factor funds. Now diversification. So, the only way to, the only free lunch, as someone said. So I like diversification because I think it's the only way to reduce sort of tail risk. So all strategies, have their own big risks. For long funds, obviously, it's markets crashing. For a market neutral or a statistical arbitrage fund, it may not be markets crashing, but it's basically whatever themes you have analyzed to do those trades, those themes go out of the window, they collapse, something weird happens in those. If you are, say, an option strategy, there could be other risks. You can have overnight gap risks if you have overnight strategies. They can be intraday flash crashes if you have intraday strategies. So again, every strategy has its own different sort of scenario where it can have very large risks, what we call tail risk. So I think diversification, at least from a quant perspective, is the only way to reduce that tail risk, because I don't want to do one particular strategy. I want to do like 10 different strategies or maybe 20 different strategies and have small allocations to each of them so that I'm not getting too much affected by tail risk happening in one strategy. So now, what kind of diversification can you have? You can have strategy diversification. So I can have momentum models, I can have mean reversion models, I can have pattern recognition. Then I can have factor diversification. I can have models on fundamentals, on technicals, on statistical methods. And then very importantly and very less talked about is time diversification. And I'm a big fan of that. It has helped me a lot in my life experience. So you can have, when you're doing shorter term sort of trading or investing models, you can have daily and weekly time frames where you're churning your strategies. And then when you're doing more long equities or long short models, you can have monthly and quarterly. So you can actually diversify across all those time frames and actually get very different results, even using the same model sometimes. Now, long short and quant, what I am doing currently is active and dynamic. So I'm trying to do more from a market neutral approach. I'll touch upon that later. But just right now, how it marries well is that in a very active long short approach, you need to take decisions very dynamically, enter and exit positions, every day, every week. As I said earlier, the time diversification concept. But you have to basically be taking decisions every day on something or the other, and across multiple strategies and multiple time frames. So obviously, even if I'm the smartest guy in the industry, which I'm not, I will not be able to do that from a discretionary angle, right? So the quant approach helps because I can create systems and rules and processes, and then that can keep doing all these active decisions very, very efficiently. So that helps. And then the other advantages of quant, of course, that you get a better sense of how performance varies across market conditions, avoiding psychological biases, right? So the whole reason why quant started long back globally is that we humans all have certain cognitive biases. So there's a recency bias. If markets have gone up in the recent week or last few months, in general, the sentiment in the room would be very bullish. If they've gone down very recently, the sentiment in the room would be bearish. So we all fall prey to that recency bias, which is one of the cognitive biases. And quant helps eliminate that, because you know that different market conditions will keep coming, and you gear your strategies and your investment process to handle all those different types of market conditions. And then risk management. So risk management is very important for certain types of products, especially low to medium risk products, where because you have strategy diversification, which I said is a good thing, but it can also become a bad thing because, which thing can lead to what kind of loss or what kind of risk is again something that is not easily understandable when you have a very complex portfolio of models. So there, you can statistically do a lot of risk management and plug that back into your portfolio decisions. So again, only being systematic or quantitative, you will be able to do that. Otherwise, just discretionarily, it is almost impossible to do that in a sophisticated manner. Now, equity long short, very popular hedge fund strategy globally. Many of us from the industry or active on the investing side for the last 15, 20 years, I'm sure have heard about equity long short globally. In India, it's relatively new, but in globally, it's been around for a long time. Some of the best hedge funds that any of you would have heard globally are typically fall in this category. One thing I forgot to mention earlier was that typically in the last few years, if you look at the top 10 hedge funds globally, whether in terms of asset size or in terms of performance, on an average, there have been 5 to 6 quant funds out of those top 10 consistently for last many years. But again, a lot of them would fall in the equity long-short category, so obviously very important. What this means is you're going long certain stocks and short certain stocks, right? Now, there can be various ways of choosing what stocks you want to go long, what you want to go short. As I said earlier, you can have fundamental techniques, technical, statistical. You can do it on a basket of stocks. You can do it on, a pair of stocks. You can have many different combinations. You can, and therefore have many different combinations of exposures. So the other flexibility it gives you is that you can dial your net exposures up and down. So globally, again, equity long short, more you find equity long biased managers. So typically the net exposures will range from 30 to 70% kind of for global managers. And of course, when markets are looking very bad, they can obviously have zero net exposures also. But typical range is 30 to 70. For Indian, certain hedge funds which have offshore funds who are doing equity long biased approaches, typically the range is much higher. It's been 70, 80%. So basically they are like long funds, but using some shorting or some index derivatives for hedging purposes, just to dampen the losses and volatility. So that is the big difference between some Indian FPI sort of funds and global funds. But you can have many different levels of exposure. In India, the other constraint is SEBI obviously has a regulatory limit. So you can do these funds in AIF category 3, and there they have defined a limit of 200% max gross exposures, which means, for example, that I can be 100 long and 100 short if I have 100 rupees, but I can't do anything more than that. I can't go 200 long and 200 short, although my net exposures may be zero. So, if I'm long some stocks and short some stocks and equal value on both sides, then I may be at zero net exposures, which I may think is low risk. So globally what happens is that many funds would go up to 4x, 5x gross exposures. As long as they're controlling the risk below a certain number, they don't mind doing that. Here, there is potential in India to do strategies like that, but there is this 2x constraint from SEBI angle, and which is why what we've seen is more absolute return equity long-short funds in the country till now. And then, of course, the risk-reward obviously varies. For the global equity long-short funds, they're trying to meet the benchmarks or beat the benchmarks. Let's say a US fund, it'll be benchmarked to S&P 500. They will try to either match the benchmark returns with much lower risk or beat the benchmark with, a slightly higher risk, but have much better risk-reward ratios compared to the S&P 500. So if, whatever the Sharpe ratio is of the S&P, these funds will try to have a much higher Sharpe ratio overall. So that is what they try to do. And the advantages, disadvantages, obviously, the advantages are that these things have low correlations to other things in your portfolio. So obviously you can combine long only, long short, even some of the other strategies that I'll talk of, and have a much more efficient portfolio. So I'll make that point on one of the slides I have where I've drawn the efficient portfolio. And then various combinations of net gross exposures are possible. So I can be zero net, 200 gross as the example I gave you. I can also be 150% long, and therefore having on an average greater than 100% net exposures. I can play around with the net gross exposures the way I want it. So there's a lot more flexibility that you have in terms of the different types of strategies and different types of market conditions that you can capture. Disadvantages, obviously, like I said, both globally and locally, traditionally we've had more long biased exposures when you're doing equity long short, which means that if markets fall big, then those funds will still fall. They may fall 70 or 80% of what the equity market falls, but they'll still fall as much. So if you're looking to reduce that risk, then obviously the 70-80% net exposure kind of long short funds will not help you. Now, one may ask that what is the opportunity, right? Why does long short strategies exist, and how can you make returns? So I have a couple of slides to just give simple examples of that. So this is something that I track. I track it more on a 30-day rolling period because I have more, 1 week to 1 month kind of strategies right now that I'm focusing on. But the same thing, you can do it on a longer time frame. If you have a longer holding period, then you can look at this data over a 100-day or a 200-day sort of rolling correlation. But what is very similar is that, these correlations go up and down cyclically very consistently. So I'll take a minute to just explain what this means. So this is basically showing you all the stocks in the Nifty 50 index, each stock's correlation with the Nifty over the last 30 days, and the average of these 50 stocks correlations, right? So that's what a single point on the chart shows you. And then it shows that to you every day for the last, whatever period there is on the graph. So as you see, that average correlation keeps going up and down. So what does that mean? On the bottom end, so which means that the stocks are lowly correlated to the Nifty. So you have a high opportunity for creating alpha, for stock picking, right? So even for the traditional discretionary fund managers, those will be periods where they'll actually end up showing, who's better than whom in a true sense, because the beta impact of the market is lower. And when correlations are very high, then everything is moving together. So it's very difficult to then actually create alpha by stock picking. So this is a simple metric which I track to see, okay, if this is a better period for basically active alpha, then are my models accordingly, which are trying to capture those opportunities, are they actually delivering or not? So it becomes a very good sort of way to gauge market conditions for those kind of things, as well as sort of treat it as a risk indicator in some sense. Then the other type of long short strategy or can be equity market neutral, where you have zero net exposures. So one example which I said earlier, 100 long, 100 short, or maybe 50 long, 50 short. So there you don't have any exposures to the market. So simple example is, let's say you take the BSE 100 index, you rank those stocks, let's say on a simple momentum metric, which is much talked about recently. And then based on that ranking, you go along the top 10 stocks in an equal weighted manner and short the bottom 10 stocks in an equal weighted manner. So if I do that, then I have zero net exposure to market, but I'm still betting that the momentum factor will actually give me returns. Because if it were to play out, then my top 10 stocks would obviously do better than my bottom 10 stocks on that ranking. And therefore I can still make, sort of low volatile returns over a period of time. And that is something that actually works, whether it's India or globally. Everything will have its patches of under and outperformance, but with relatively low drawdowns and low net exposures, you can actually make a lot of money in something like that. So that is one simple example of a market neutral approach. But you can, again, like I said earlier, have many different ways of doing this. So here, obviously, it's low risk because there's zero or close to zero net exposures. And therefore, your returns can be a little more consistent, right? Even if markets crash, you would ideally expect a good fund in this space to, at least give you some returns or at least not lose a lot of money. And therefore, you can have much higher risk-reward ratios than the equity funds or the earlier category of equity long-short typically. Advantage is, obviously lowly correlated. So even if markets are doing nothing, some of these funds will be giving you some returns, or if markets are crashing, these funds will give you some returns, as I said. So obviously having some allocation to that in the portfolio helps. And the attractive risk-adjusted returns in there, you're getting, certain returns with low risk. So all those are advantages for this. Disadvantages are that sometimes in stress situations, the correlations break down, as, again, is well talked about. So some of the correlations or other statistical analysis used for these kind of strategies, that can also go haywire, and therefore some of these funds can still end up giving you unexpected losses in those kind of market conditions. And therefore the risk monitoring and risk management is much more important in these kind of funds, because that is something that can sort of warn you ahead of time that something is going wrong in whatever strategies you've developed, and therefore you need to step in and control that. Otherwise you would have unexpected losses which you've not seen in the strategy maybe for a long time, but certain market conditions come and you can see those kind of losses. Now again, these two slides for both types of equity long short as well as equity market neutral sort of lay the case. What I was mentioning earlier, I showed you the correlations more to show how you can have high alpha opportunities and low alpha opportunities. But these are simpler ways of seeing why the long short or market neutral has a space and has potential to make returns. So here if you see, these are the various indices right? NSE indices. And if you see it for the last 11, 12 years data that is shown here, you see a huge dispersion in returns across indices, right? So every year, the best and the worst indices, there's a huge difference in returns. Now, what if you were to go long some of the better performing? So obviously, you'll never get only the best one and only the worst one. It can't be like a perfect model, but you can at least be extracting some part of that difference. So if you take the top 3 sectors and the bottom 3 sectors, let's say, and you had a model which was doing some sort of sector rotation, and you were able to go long some of the stocks from the top 3 sectors and short some of the stocks from the bottom 3 sectors, despite having zero net exposures to the market, you would actually make returns, right? So that is what this is trying to highlight. And then the next slide is sort of related. It is showing you within each sector, the dispersion of returns. So again, some of this intuitively and practically some of us have noticed. But what is interesting is even if you look at the long-term data, it is very, very consistent that even in each index every year, the difference between the best and worst performer or even best and median return or worst and median return is very high. So again, there's a very big spread. And if you were able to pick some stocks to go long and some stocks to go short, even within each sector, you could be zero net or low net exposures to the market and still make a lot of returns. So these are the quick, ways you can look at the data to get a sense of the opportunity that is there in some of these strategies and initial part of how you can analyze on, what kind of things can actually make you returns and create certain systematic or quant models around that. As I said earlier, in India, absolute return long-short fund is a category which is got created because of some funds doing well and becoming larger in the space over the last 10 years. It is a little particular to India in that sense. How these are trying to operate is with very low risk, let's say not more than 1 to 2% max downside risk, trying to generate like 12% returns in the market across all market conditions. So obviously it sounds too good to be true that in up market, down market, sideways market, you can make money while doing some of these active derivatives or long short strategies. So I've briefly mentioned on how that is possible. You can have low net exposures but have slightly long exposures or slight short exposures by all the quantitative modeling, of course, which will help you to actually make money in up and down markets. And then you can have certain models like the market neutral ones, which actually make money in sideways market also. And then you can play around with those weightages that you have across different strategies. And that's how you can be consistent across different market conditions. Now moving on to the next sort of larger category, so managed futures, or what till 10 years back used to be called CTA strategies. It is one of the largest hedge fund strategies globally, actually, apart from equity long short. And in fact, at some point in the last 10 years, it actually overtook equity long short as the largest global category. But something which is not very popular in India, or at least not institutional. So there are smaller players in the country who are active in this. I have been very active in this in the past. And I think it has a lot of advantages, which is important to understand. So globally, the way it operates is under managed futures. There are some very large and successful funds. Some of the names I've mentioned here, Winton, Man, there are many others, Transtrend and others, which have done very well and have 20, 30, 40-year track records. So unlike what we think here, these are things that have done very well in the long term, right? Which is why it's important to understand more about them. What they operate is in more momentum and trend following. So they say that, okay, trends happen across all asset classes, and therefore have a very well diversified approach. You go global, you go into many geographies, many countries across the world, and then you go across asset classes. Why only equities? You can go into commodities, currencies, fixed income, and globally, of course, you have index futures across all the asset classes, right? And therefore, you can have, typically these funds would trade 70 to 100 instruments, if not more, across all these asset classes. So you will get asset class diversification, and then within that, you will be able to go long and short those futures which are going up or down very strongly. So obviously you get much more opportunity to basically tap into the return making or alpha making opportunities. right? So what is interesting is that obviously it is exposed to many asset classes, and then these funds go long and net short also. So therefore, they can actually work very well in large crashes, for example. So there is consistently these funds globally have made money in all the crisis periods the world has seen since the 1990s. And in my live experience also, some of the managed future strategies I have been running have again always done well in large crashes, whether it was 2008, 11, 20, across those periods. So I've seen the advantages of some of these things very live, right? And then the other advantages, as I said, obviously lowly correlated, in fact negatively correlated in the big crashes. So that is a unique feature that this category has, which no other category has, and therefore becomes very interesting from a portfolio construction perspective in some sense. And I've mentioned there crisis alpha. So that is a terminology that has come about to be spoken globally, and a lot of pension fund money has moved into this over the last many years. So that is some interesting development, because in India, you think that, okay, if someone is doing futures, it's retail or it's a non-institutional strategy. But what is important to understand is that large pension funds globally have seen the advantage of this over the last 30 years, and therefore are some of the biggest allocators in the space to balance the risk that they see when markets actually crash, while being absolute return otherwise. So it isn't as if, it's just providing you a hedge. It is actually making good returns over a longer period of time, and also doing well when markets are in trouble. Disadvantages are that obviously it can have long periods of not giving you any returns, right? These strategies, so as we say that, trends tend to whipsaw. So markets will go up, your models may be going slightly net long, then markets go down, then they become slightly net short. So in those kind of whipsawing sideways periods, these kind of strategies will lose. And that is why the diversification across 100 instruments by some of the global funds. But even across those 100 instruments, sometimes you don't get enough opportunities to make money, and therefore there can be extended periods of time where these strategies are flat to slightly negative. And that becomes a problem for a lot of investors, because typically we don't have patience, right, in something that we don't understand. So the moment it is systematic, it is quantitative, for a normal investor, there is a black box element to it. And therefore, when a very long period of no returns come, then you start questioning that, is it strategy even viable or not? But like I said, some of the funds in the space have very long-term track records. And therefore, there is a method to the madness. It does really deliver in the long run. And therefore, is something that needs to be looked at very closely. This is the interesting slide that I was referring to earlier. It obviously dwells more on managed futures, because that has the best impact on the efficient frontier. But even some of the other strategies, equity market neutral, stat arb, equity long short, if you look at some of those and include it in your analysis, you'll actually end up getting similar results. Obviously a little poorer than what you're getting by managed futures, but you'll still get a better efficient frontier than just combining equities and bonds, right? So as we know, globally and even in India, globally, of course, that 60-40 equity bond portfolio. Locally also, different wealth managers and different firms have different philosophies around it. But typically, you combine some equity and bonds. Now people have started talking about combining some alternative strategies. But alternatives is obviously a very big world, right? You have PE, VC, real estate, and then you have these kind of strategies. So I'm saying even while being very liquid, stocks are something you can enter any day that you want. You have liquid bonds which you can enter, exit any day you want. And then you have these managed future strategies or some of these other strategies I've talked of, which are also very liquid. You can enter, exit any day that you want. So if we just combine liquid strategies, right? I don't want to take the illiquidity sort of risk. If I don't want that, because that obviously should have its own premium if you're going into illiquid things. If I want to be very liquid and still get an alpha or be better on the efficient frontier, then how do I do it? So this simple thing shows that if you just add 20% managed futures to an equity bond portfolio, and this is US data, but you can pick any data in any country in the world and you'll get the same result. If you combine that, then you're much better, much more efficient on the efficient frontier. And that happens because of what I said earlier, that managed futures is actually giving you long-term good returns, but it is actually making money in the big crashes. So that is why it is leading to this kind of effect. And overall, this category has low correlations to equities. But if you break it down, then you'll see the positive correlation in up markets, the negative correlation in down markets, and low correlations in sideways markets. And that is what on a combined basis is, overall also showing you low correlations. This is sort of on a practical level showing you the combination. So earlier one obviously showed you the efficient frontier, but let's leave bonds out for a minute. In India, we are all fans of equity investing, especially I think most of us in this room. So if I just combine long only equity with managed futures, so we are all big admirers of Warren Buffett. So the long only equity is his track record. This is again a little dated. It may be from a few years back, but whatever till that period, whatever his track record was. And then there is an unknown to us in the room, known in the managed futures world globally, but not the best or the largest fund. It is a fund which has a 30-40 year track record, right? Called Abraham in the managed futures space. So its track record. So if you see, I mean, it's delivered very good returns, right? But we don't even know about it. But what is more important and what I wanted to highlight was that when you just do a 50-50 equal mix between the two, then you actually get higher returns and lower risk, right? So sort of magic gets created. And that is to do with this non-correlation and the fact that the managed futures strategy does well when markets fall big. So obviously your risk becomes less when you're combining both. And if both have good returns over a long period of time, then your returns will obviously be as good or better because of compounding effects. Because if you're falling less, then obviously you need lesser to catch up also. So your returns will actually increase if you fall less. And if your long-term returns are not, getting deteriorated, then it's even better. So that is what is very interesting and, what I've personally also used in the past in India, and it really works very well. Now, this is an interesting, simple analysis, which shows why it should matter. So there's a lot of talk, not only in India, but globally also, that timing doesn't matter, timing doesn't work, etc. This is a simple thing which shows you if you eliminate the best and the worst days from the market, right? So again, from the long only industry, we've seen the bottom part of the graph, that if you, miss the best days in the market, then what would happen? So, therefore you're better off being always invested, which is true till you look at the picture till that level. But look at the top graph, which is just going out of the park. It's hitting the ball out of the park. That is if you miss the worst days in the market, right? So you have a much bigger impact by missing the worst days in the market, which has not been talked about traditionally in India, which means that timing can work. So now, obviously, as I said earlier, none of us is perfect. You can't get perfectly out of the worst days in the market because some of the best days in the market come also clustered around the worst days in the market, right? When volatility is really high, you'll suddenly get a 10% crash. You'll get a 5% up move the next day. Things like this keep happening. So you can't miss only the worst days. You'll obviously also miss some of the best days. But let's say you miss a mix of both. You can still end up being much better than just being passive long equities. That's what this slide is trying to highlight, and which means that timing can matter, and therefore also the case for futures momentums kind of strategy. Now this is my live example actually. So I had run a managed futures strategy both in India and Asia for many years, and this is the India one, and it's showing you the scatter plot of the returns of my strategy versus the Nifty. And if you see, there is a nice sort of smile, long volatility smile with strong tails. So basically in big tail events, whenever markets have crashed, the strategy has made money, which was the point I was referring to earlier. And then there is this long volatility smile, which means that you're almost, high returns in up months, in strong upward momentum, and high returns in strong downward momentum. And when markets are flattish or range bound, you're actually having some small losses. So that is a very desirable impact to have on the portfolio. Everyone in the world wants long volatility or tail risk strategies. And typically you end up paying cost for those. Here you're actually making returns and still getting that benefit. So that is very interesting. And the other thing is, again, this is from my live experience, the return distribution. So typically long equities have what is called a negative skew. And that is why you lose big when markets fall. Managed futures have a positive skew, and that also relates to why they make money when markets fall. So this is showing you from live data the slight tilted on the positive side kind of skew that is there, while almost being a normal distribution, right? So the live data points are very close to normal in the middle, but a little tilted on the right, which means that very high returns are more possible. Very low, very big crashes in the returns are not typically seen. Then moving on the more hedged and arbitrage kind of side, statistical arbitrage, it's in some places put in the arbitrage category, some places it's a subclass of market neutral also. But it's sort of a separate category of its own because there are a lot of statistical arbitrage funds globally which have large AUM. So, we should look at that strategy separately. It's a very active strategy. It is also market neutral, as I said, which is why it can be clubbed into market neutral also. And it utilizes mean reversion. So while things like managed futures and some equity long short use more of momentum and other fundamental factors, this looks at mean reversion and therefore is more statistical in some sense, right? So a simple example is in the same sector, you go long a stock and short a different stock. You'll obviously have to do it via the futures market in India because you're shorting as well, and the borrowing mechanism is not so big in India. But the futures market is very, very liquid, so you'll have to do it via that. But the whole goal is that within a sector, if two stocks which are tightly correlated with each other diverge, then you can go long one and short the other and make returns while again being not exposed to the market. So that is what it tries to do. Therefore, it has a zero net exposure, beta, whatever, however you want to look at it. And these strategies have many different techniques. Correlation is a simpler technique. There are others also. You can make it as complex as you want. And, in India, we talk of pair trading, for example. So that is a form of statistical arbitrage. Disadvantages, again, similar to market neutral, are that sometimes the strategies, instead of converging, because here you're betting that the relationship between, let's say, Infosys, TCS, or Axis, ICICI is going in opposite directions. They're right now diverging, but they will converge at some point because of whatever statistical analysis you've done. But they don't. For other fundamental reasons, they keep diverging. Then obviously the strategies can lead to much larger losses than whatever you've modeled for. And therefore stop losses and other risk management techniques are important in a strategy like this. This is an actual example of an Infosys TCS that I've shown here. The graph basically shows you how they're sort of moving in tandem. If you just look at the stock prices also, you see that largely they're moving up and down together. And the statistics on the right, of course, is trying to show what standard deviation from the mean the ratio is moving up or down. And then, of course, beyond a 2 standard deviation or a 3 standard deviation move, you want to come in and play the trade on so that it reverts. So it's a mean reversion trade, right? And usually you will do it in stocks in the same sector as a pair trade in India especially. But you can actually expand the concept and do it across a basket of stocks also. And then you can expand it into not only the same sector, but across multiple sectors as well. So what is globally called as principal component analysis, right? So you can actually sort of reverse engineer what group of stocks are sort of moving together, because it may not be the same sector, there may be different reasons for it which we don't know. And then you can actually make things market neutral arbitrage sort of mean reversion trade from that grouping perspective, however you are grouping it. So it can be made, again, as more robust and more complex as one wants. But this simple example highlights on what the opportunities can be, because you're not betting on Infosys or TCS moving up or down. You're just betting that the relation sort of continues because there's no extraneous impact on any of the two stocks that is going to come in. And therefore it will hold up to that historical relationship. Then option strategies. I think a lot recently has been discussed and talked about option strategies recently because of the huge volumes that have been seen in India in the last few years, right? So what is interesting is that the index options especially, Nifty, Bank Nifty, even Fin Nifty now, the volumes have just gone through the roof. right? So we are trading more than $3 trillion notional value of index options every day in India, which is huge, right? It is something none of us would have thought of 10 years back. And it puts us in the top 2 or 3 markets in the world on index options now, maybe second only to the US or maybe third, China and some European markets. I don't remember the data. So it's really large, which means that there are opportunities there. And the other thing about option strategies is you can create strategies on different types of market conditions, right? You can have option strategies for stable markets, volatile markets, range-bound markets, directional moves up or down, and then you can have much better risk-reward ratios because you can be hedged in a lot of these strategies and still make outsized returns. So because of varied combination of risk-reward ratios, varied combination of market conditions that you can capture, it becomes, and the huge liquidity obviously now that in index options especially has come in, you can do a lot of things using option strategies. But as I've mentioned here, the devil is in the details. Because the liquidity is so high, because a lot of trainers, influencers, all of these have been talking about how it's been so easy to make 2%, 3% per month. Because of that kind of talk, a lot of retail and not so experienced people basically have got into that space. And people just assume that you can go and sell straddles and strangles intraday, cut it end of the day and make a lot of money. And obviously, as we know, these are markets. Nothing is so simple at any point in time for any strategy. So firstly, typically there are phases in the market. So firstly, obviously, weekly options was not there in India till a few years back. So obviously, you could not do some of these things. Then weekly options came in. Then as the liquidity picked up, some of the smarter players in the market started doing some of these strategies. They made a lot of money. Then there was a buzz around it, in social media and other places. So now, over the last year, the whole world has got into doing some of these things. And therefore, the opportunity has gone down, as would happen in any, segment. When there are less players involved, when there are some inefficiencies in the market, then obviously there are better returns. Once those inefficiencies go away or there are more market participants, then the returns are not as great. So that has started happening now in that space. Plus, overnight strategies have their own risk because you're exposed to gap risk. At some level in options, typically there is the data that 90% of option buyers lose money. So because of that, more people and professionals especially would sell strategies, sell options and have those kind of strategies. But those are exposed to overnight risk even if you are hedged, because your hedging will start, 1, 2, 3, 4% away. And when you're making returns, you are actually leveraging up on your notionals because everyone is looking at their returns on margin and not on the notionals, right? So therefore, even a 2, 3, 4%, loss because you're hedged that much away, but if you're levered up 5 times means that you can still have a 20, 30% loss. So that is something which, again, inexperienced or new people in the market are not really studying closely. And then people think that, okay, intraday strategies means that overnight risk is not there, so it's safer, which is true from an overnight gap risk perspective. But intraday has its own issues. What if the US kind of flash crash happens, right? The moment that happens in India, you're going to actually see big problems from all these market players that have come in over the last 1 or 2 years. So that is sort of a dangerous trend, according to me. It does lead to some other things. It reduces the vol in the market. The volatilities have been very dampened, as you've seen in the last few years. That is a little bit related to this trend of intraday options trading happening. But like I said earlier, we should focus on, the fact that these strategies can be done in many different ways to capture many different risk-reward ratios and many different market conditions. And therefore, it becomes a very interesting addition to any sort of portfolio of strategies. And so largely, those things covered the strategies. I'll quickly touch upon some other things. I mentioned a little bit about this, the different cognitive biases that a quant process eliminates. You can look up some of this later, but it's important because as discretionary traders or investors, we all fall prey to that. So it's important to be aware about it at least, even if you have other styles of investing. And then very important, wanted to spend 2 minutes on the issues with quant investing and how to mitigate risk, because some of the positives about different strategies and a quant approach I highlighted. But there obviously it has to be done in the correct manner. Otherwise, it's like garbage in, garbage out, right? If the wrong data goes in, whatever analysis you do is meaningless beyond a point. So cleaning the data is very important. A lot of times, certain fundamental data will not be clean. So you need actually some people in the team to be making sure that the data is clean. Whatever databases you may be using, there are some problems. Somewhere the fundamental data is not okay. Somewhere the price data is not okay. Earlier today, I was discussing with someone that demergers, that data is not clean post demerger. Even the price data sometimes on some databases doesn't adjust for that. So those kind of things need to be done, and correctness therefore is very important. And then there is this thing about backtesting, right? So I'm sure most of us in the room have seen very good backtests, and then they don't work well in real time. Now that is because the backtest itself, the process needs to be very robust. So there are ways of ensuring simple things are mentioned here in sample, out sample. So you need to basically be simulating or backtesting on a certain sample of data, and then be leaving some part of the data on which then whatever results or whatever parameters or whatever rules you decide based on the in-sample data, then you apply those on your data that you've not used in the in-sample, which we call out sample, and then see whether the results you are getting are interesting enough that you thought or not. That gives you a sense of how the models will work across different market conditions, basically. So that is important to do. Most of us, don't do that. You will actually use your rules on the entire data, see that, okay, this is showing good results, but there a certain bias is coming in because, we've all been in India, seen Indian market. Somewhere in our subconscious, we know largely how the markets have gone up and down in different periods. So you'll end up thinking of rules, which are confirming your subconscious, basically. So you need to eliminate that to be getting results which are actually usable in real term. And then, of course, very importantly, trading cost slippages, right? So the more active you are, for example, when I am doing 1 day, 1 week kind of models, which will have higher churn than the monthly or the quarterlies, and if I'm at very large size, then I am impacting the trade myself, right? I may be playing for a small, let's say 2% or a 3% mean reversion trade, let's say on the stat arb side. But if my size is big enough that I go and impact and reduce that spread, and the 3% opportunity becomes 2% or 1%, then there's no point in doing the trade. So a lot of times, again, when people are not doing it in a robust manner, they're not accounting for these trading costs and slippages and other things. There's a whole quant world out there which actually focuses on that, which is at least at a basic level important to do for any quant or systematic manager. And then, of course, having global experience helps. So because I've managed an Asia fund in the past and done a little bit of prop in the US, so that helps because there are certain market conditions India has not seen, right? So the more data that goes into building a model, obviously the more robust the model is. So for us, let's say I'm building something on the index, then I have to look at data from 2001 when the index started. People typically look at the last 5 years or 7 years and then come to some conclusions, which is not correct. And even for me, even 20 years is not good enough. So a lot of the models that I build, I'll look at the US markets because I can go back 50 years or even 100 years in some cases and actually see what that model would have done across different market conditions. So that is also very important to do. And this initially also I touched upon. So there are some players across different categories that I talked of. But you can, in the interest of time, look at this later. So again, there are a few names in each of the categories which are either doing something or have built size or built a good track record, etc. And that is an interesting dynamic that has started playing out. Then, since this is a CFA event and, I'm happy to be here. So also quickly, a few minutes about the different work involved in different areas of quant. So some of the people aspiring to come into the quant industry, you get a better sense of what kind of roles and responsibilities and work can be there. So earlier I mentioned about, some of the different aspects of quant. So here, as you can see, you have research, you have trading, you have risk management, you have analytics. So all of this in some ways is related to, let's say, building a quant fund. Obviously trading, as I mentioned earlier, execution focused strategy. So a lot of the algo and other things that we talk of would fall there. Then even for our quant funds, we have risk managers. So a lot of risk modeling, and even on the factor models, what kind of risk can come in, all that will fall under risk management. Option strategies, whatever risk is there, even on the Greeks and other things, that would all fall under risk, and you can be fully quantitative about it. And then, of course, research is the biggest area which I also focus on. And then a lot of the post-trade analytics, or even the slippage analytics and all that, I would put it under somewhere overlapping between analytics and trading. And then there are roles available across all these 4 functions, right? So you can be trader in a hedge fund, mutual fund, there are prop desks, sell side. In globally, there are a lot of sell side, large bank brokers who do a lot of good quant research. In India, it's still not as much, but I think in the next 5 to 10 years, that will also pick up. So there'll be a huge scope there as well. And then risk management can be at hedge funds, some of the same hedge funds, mutual funds, prop desks, but also exchanges, right? So the biggest, I think, risk management has to be done at the NSE, for example, and so many trades and so many other things are happening. And there, it would not only be the software, but also the hardware, similar to HFT kind of strategies. Managing risk on the hardware is very important. And then in research, I think all of you are aware, analytics also on asset allocators or data providers. So the data providers is also a big segment, right? So there a lot of analytics gets used. These are the different skills required for the different roles. And of course, in India, it's a small market right now. We are still scratching the surface, and therefore, talent is always a problem. So globally, you have quant funds hiring a lot of PhDs and people with expertise in maths and physics and mathematical physics and whatnot, very complex subjects, and wanting those non-finance ideas being applied to finance to get better results and better models, etc. In India, because the market is not well developed, so obviously we don't have that. But other qualifications obviously help. CFA helps on the fundamental factor quant side, having that background really helps. FRM on the risk side. So like that, different things will help. And then you have specialized, obviously, quant courses and all more from global institutes, which will help. But otherwise, having some background to finance or analytics is obviously very helpful, as you saw in the earlier slide also. But more important than that, I give a lot of importance, for example, to a lot of creativity and using your common sense beyond a point. So I don't like the models to be fully black box. I would like to also understand the common sense behind why a particular strategy is working or not working. So I think a lot of creativity around that can be used. A lot of market observations can be converted into very good models. So that ecosystem also can develop much more than what we see today. That's all that I have for today. Thanks.
Before we start the questions, so investing is about delaying gratification, right? So we have lunch outside. We are running short of time. So I would request that lunch be delayed a bit. So just delaying gratification there. So you mentioned a very interesting point about crisis alpha, right? Recently, we have talked a lot about tail risk hedges. Tail risk hedges versus crisis alpha. How do you differentiate these two?
So tail risk is an interesting concept. So globally, there are tail risk funds which would say that only when big crashes happen, those will make money. Except, I think, one or two names like Universa, most other funds have not really done as great as whatever the objective was. And the downside to that is that they will keep bleeding for long periods of time. Even for Universa from 2010 to 20 before the COVID crash, for 10 years they were like having small bleeds. And I think some of those are good strategies for hedging a long equity portfolio. But the problem is again the mindset, right? We can't be patient for 10 years and not have something play out. Whereas on the other side, the pros and cons of managed futures for crisis alpha is that in the long run also they are making returns, right? So you're getting a 12%, 15%, whatever, depending on the different funds, whatever track record they have. So therefore you can be a little more patient in those and they still give you some protection in the big falls, right? The downside to managed futures is that if you ask me today that, okay, tomorrow markets were to fall 20%, what would a typical managed futures strategy deliver? I don't know. Because the payoffs are not like an option strategy that if it falls this much, I know exactly how that much will make. So it also depends on which instruments it is trading, whether it's a short-term strategy, long-term strategy, etc., etc. So I think there are pros and cons to both. And in some sense, the slide that I showed where you're combining equities and managed futures, I think you can effectively be using both, because on that equities portion, you can still overlay tail risk and actually make it an even better strategy than what I showed.
And if you combine tail risk to that, tail risk hedges to that?
That's what I'm saying, that if you combine that, then I think it becomes even better, because even the equity piece improves a little bit, and then the combination obviously will be a better.
And is there a way you can break down a tail risk hedge for us? It's something that we have heard but never seen. Say what Universa does or something.
Yeah, so see, in India what we've seen is obviously there have been funds or larger as well as smaller shops in the past which have played around with simple things like buying an annual port or buying sort of monthly puts or put spreads or something, which is very simple. Obviously there's a cost to it, and therefore in the long run it doesn't play out, right? Whereas the tail risk funds that we're talking about, which have done well in the West, they play on slightly longer dated options. So they'll buy typically say quarterly, 3 monthly puts, because the data that is there is that obviously you make money on the big tail moves because volatility spikes up, right? And that is where these tail risk funds try to capitalize on it. And the longer you go slightly, you will actually have a better impact on those volatility spikes. So I don't want to, bore everyone with those specific Greek terms, but basically the longer term strategies will have higher vega, and then the sensitivity of those vega changes will also be higher for them. So that is what makes that 400% kind of some crazy return. But of course these have to be really out of the money. You'll be buying 15, 20, 25% out of the money sort of 3-month options, and then playing around in the near term with how you manage that up or down. And there can be many different styles. You can have it passive every 3 months. You can have a rolling 3-month hedge, do 10% or 20% every week, every month. Then you can have variety around it. But that sort of 3-month or 6-month kind of puts and really out of the money, so that then you're getting it very cheap, and therefore you're sort of buying 10x of the fund size, right? You're not buying 1x. And that is what is then giving you the impact.
But so the strikes could move too, right? So what is deep out of the money could be deeper out of the money.
Correct. So yeah, so then you can get more active on it. That is why 3 month, not 6 month or 1 year, right? Because at least then every month you can keep buying, say, 1/3 of 3 months. So you can break it down over 3 months, 1/3, 1/3, 1/3, and then say every month I will buy 1/3 of the next 3 months. So at least on a monthly basis, your strikes are coming closer. Let's say markets are rallying, then your strikes are coming at least going up and not remaining static. The problem with the 1-year passive put hedges that we've seen in the past in India has been that they remain static. Now the markets are 20% up. Now that hedge is meaningless for you.
So you mentioned this interesting point on gamification, where there is a lot of trading on the short-dated options. So 2 things there. When you look at it, it is suppressing volatility, right? So some of your quantitative strategies, so you split them into 2 when you mentioned trend following and mean reverting. So example, if you look at mean reverting, they are a function of volatility. So the higher the volatility, higher the probable returns. Now, gamification and vol suppression, how do these strategies, do you expect them to perform?
Yeah, so it does affect, and that is why what I mentioned that, the longer data and the more market conditions that you can analyze while building the quant models, it always helps. Because while not for the same reason, but for other reasons at different points in time, there have been long periods where vols have been suppressed, for example. So at least if you've done your modeling on those periods, then the models will hold up to such periods. That is my broader comment on this. But coming back specifically to your question, yes. So this all intraday options activity that we are seeing in India has ended up dampening the volatility that we are seeing, which is why you're seeing VIX, remain at 9, 10, 11, that range, irrespective of whatever news about wars and other global geopolitics or even local news that is coming in. So that is big time responsible for that. It has some good and some bad effects, right? The bad effects is that obviously you are less sort of prepared for the really large tail moves, because typically when volatility starts moving up, then not only do you get opportunities for different strategies, but also you start getting some risk indication that, okay, now if it shoots further up, there could be a big crash. So you can actually use it effectively for risk management or for position sizing for some of the strategies, which is not really easy to do right now when vols are suppressed. So there are those issues. The good thing is that, for long only funds in some sense, right? When vols are low means they are actually having less impact in the market in some sense. So for them, the slippages and all that is much lower. So there has been a huge, hue and cry about all these index options volumes going up. And I think a lot of the long only managers have also been thinking that derivatives market volume going up is not healthy, etc. But there is a flip side. I mean, actually, some of them are benefiting from that as well. But yes, when the volatility spikes, there could be issues, which is something we have to look out for. For the specific strategies, there are phases actually. So file something like statistical arbitrage pair trading, the more volatile it is, the more opportunities I get and the more churn I get, and therefore you can go out and make slightly better returns with lower risk. But at the same time, my per trade risk is higher, right? Because I can have much wilder moves and my stop losses may get triggered with a gap, and therefore I lose more than what I modeled for. In low risk periods, the opportunities are lesser, but then I don't get those tail moves, so my risk gets managed better. So there's some give and take, I think, overall, which is fine. For the managed futures side, what happens is with low vol, if you have trendless markets, then obviously that is the worst combination of market conditions for those strategies. But if with low vol there's a trend happening, then we are happy in managed futures.
So how has this, so you gave a lot of examples on US and some in India, right? So Japan has been a dead market. So how has quant strategies worked there?
Yeah, so overall, I think for StatArb, it's been a fantastic market, right? StatArb opportunities have continued in Japan and been in Japan for like 50 years. And they continue to give a lot of opportunities because despite dull markets, all these intra-sector, inter-sector, different types of divergence and all have been continuously happening. In fact, when markets are dull, I mean, why are they dull? Because some stocks are going up, some are going down, all types of moves are happening across stocks, which means the opportunity for things like StatArb and market neutral is higher in those periods. But for a lot of directional strategies, obviously it's not easy.
So another thing that you pointed out about model calibration and model death. So how do you handle it? So when do you realize that the model is died? Relationship do break down. So when do you realize as a manager that this relationship is no more valid?
Yeah, so it's a very, very complex problem. I don't think anyone, even Jim Simons, has fully solved it. But there are some thumb rules that you can use. One is that you have a distribution of your trade returns or your investment returns, whatever, depending on the model you are doing. You have that trade distribution. Similar to how on a pair trade you are trying to see that, okay, a ratio of prices is going beyond certain standard deviations. On the distribution of returns, you can actually do a similar analysis. And then say that, okay, your returns are going below certain standard deviations or whatever, or even your patches of winning and losing trades is going beyond a certain distribution. So those typically can alert you to something falling apart in the model. And then, of course, dumb rules like having absolute stop losses, modeling your drawdowns and worst periods, and then something is going beyond that. That also helps as a completely final rule to exit something. But before that, analyzing the distributions of trade statistics is very useful.
And you mentioned about calibrating models, measuring models. So how frequently you do that? The more frequent you are, you might end up fitting.
Yes. That is a very important point actually. So in fact, most of us, if we don't have too much background about the topic, we think that the faster we update the models, the better. But I think that's not true, which is what you're also highlighting. It needs to be linked to the time duration of your strategy, right? So think of it in this manner, that basic statistics tells you that you need 100 data points minimum to come to some conclusion by analyzing that data. So if I'm using daily data in my models, then roughly 100 data points means around 5 months, right? Because 22 days, trading days in a month. So unless if I do my recalibration before 5 or 6 months, it is actually not correct, firstly statistically. For a high frequency strategy who are doing thousands of trades in a day using millisecond data, obviously they can update their models every week. So it needs to be linked to the number of trades that you're doing and the timing, frequency or trade duration in some sense.
So I'll take a few questions from the audience. A couple of things on, very interesting thing on artificial intelligence. Do you think artificial intelligence has a role to play in Indian markets?
So globally there are funds which have tried to apply AI on the markets. I think there is some application, but not in the way we would all intuitively think. So I'll break it down. So artificial intelligence and analytics around that, I think very useful for organizations and businesses, etc., which we've seen also good impacts of that over the last many years. And that's because, if you're operating in a certain segment, you have certain type of business, obviously there are certain, there's a limit to the truths that are there basically, right? But in markets, there is no limit. There are unlimited strategies and unlimited type of factors that affect it. So that is where the AI, while it looks intuitively that is where it should help, but that is where I think that element of curve fitting sort of starts coming in the more you start using AI, right? So we didn't touch too much upon the curve fitting aspects, but the moment you start iterating on a lot of simulations, lot of models, and then so the more parameters you have or the more iterations you do to arrive at a model solution, you have a very big risk of overfitting. And AI ML indirectly goes and does that. I don't think it is very healthy for that. But once you have, let's say, for example, I have 100 models that I've shortlisted for a certain product. And then at different points in time, I want to choose on various parameters which models to run and which not to run. I think there it can be very useful.
So AI can be choosing a factor rather than, or weighting a sub-strategy.
Yes.
So it's an interesting question on how many variables would you look at? Would you prefer a model with lesser number of variables or more number of variables?
Yes, lesser number of variables. Because like I said, more number of variables means it's overfitted. If you give me any return series, if I use enough parameters, I will get a perfect fit.
So a simple model which explains most of the returns is better than a complex model which explains, every percentage of the return.
Correct.
There's an interesting question on benchmarking. So in quants, how do you benchmark quant strategies? What is the right benchmark to use?
No, so it depends on the category, honestly. So if I am a long only quant, then whatever. If I'm picking only large caps, then Nifty 50 or BSE 100. If I'm a multi-cap, maybe BSE 500. So traditional benchmarks for traditional strategies. And if you're long short or market neutral, then of course the benchmarks will need to change. But like, for example, the absolute return strategy I talked of, which is a category in India, I'm also running a fund on it. There, because we are targeting fixed income plus returns, so the benchmarks will be fixed income plus, like a CRISIL, Liquid plus, some of those benchmarks are there. Then those benchmarks will be used. So whatever the category, if it's low risk, then low risk benchmarks. If it is high risk, then those benchmarks. If it's equity, then equity benchmarks.
So I have one final question. So you mentioned about these regimes. You said you will backtest over long periods of time. So regimes do change, right? So during that period, and do you explicitly model the current regime to see how the model has performed in similar regimes in the past, or is it?
Yeah, so we would see that. So as I said, every month or every quarter or every 6 months, so every month, every quarter, I would do a simple dive into any basic red flags that come up in our process. But the key deep dive is every 6 months. Like I said, at least 5-month data is needed because I'm using more daily data. So therefore, every 6 months. But in that deep dive, we would look at some of these things.
Final question on position sizing. This is something I should have brought up early. How do you look at position sizing? Because you said 100 different trades. So are they automated as well, or is it discretionary, or is it?
No. So for me, that is fully systematic. But yeah, that's again one of the most difficult questions. If I have, for example, 20 models in my fund right now, then how do I weight them? So for me, I do a risk-based weighting. And for me, what are the two key risks? One is drawdowns, absolute losses, right? And second is correlations, because I'm choosing these models which are non-correlated or lowly or negatively correlated to each other. So my key risk factors are drawdowns and correlations. So I use those in a risk weighting algorithm that I've created over the years and use that for position sizing. But of course, there are other ways of position sizing, right? You can, for example, a Kelly sort of approach is something that is talked of in the literature, which is very good and interesting from a, let's say, a personal trading or investing standpoint, because it basically maximizes your geometric rate of return rather than your arithmetic rate of return, right? And that is what you want to do in markets. So therefore, that kind of approach or optimization is very useful. It originally came from the betting industry, but when you're looking at quant and systematic models, obviously you're defining your risk reward and therefore wanting to do your position sizing where that is equally useful.
So, but all of this can correlate in a crisis.
So yes, so see, the traditional equity bond thing can correlate because bonds can do also as badly in a crisis as we've seen in the past. But which is why adding these different strategies and different time durations helps. Because let's say I'll give you a very simple example. If I'm doing a momentum strategy on the Nifty index and I'm doing a mean reversion strategy on the Nifty index, there's no way those two are going to have the same trade. So I've eliminated the tail risk correlation issue there. So if you start thinking of it in that manner and then combining trades or strategies or instruments, then I think you're fine.
Thank you, Rishi. Thanks a lot.
Thanks a lot.
Thank you, Rishi and Vijay Anand, for giving the insights. Now I call Srinivasan, volunteer CFA Society, to give gifts as token of appreciation from the society.